Michael Burry, I don't know if you guys have watched The Big Short or not, but he was the one who made a ton of money by betting that the housing market would collapse in 2008. Fast forward 13 or so years, and he is sending another warning our way for us investors. He thinks that index investing, stock hype groups, and free money is causing the stock market to soar in terms of prices, and he warns that this may not be sustainable. Here's what he said. Speculative stocks, #bubbles, ultimately see the gamblers take on too much debt. The market is dancing on a knife's edge. People say I didn't warn last time. I did, but no one listened. So I warned this time, and still no one listens, but I will have proof that I warned. So these are big words from someone who has a proven history of predicting correctly a market crash. Obviously that's what he did back in 2008. He even went on further to make his Twitter display Cassandra. This is a reference to the priestess who in Greek mythology was cursed to share true prophecies and no one ever believed her. Burry in some way is saying he is the financial version of this priestess. He's freely giving out warnings on his Twitter account, but not too many people are paying attention. They're just enjoying the short-term returns that they've had. But let's see who wins in the long term. So I want to dig a bit further into some of the things that he's saying and what we need to watch out for as investors. First of all, we've got to talk about all of these hype groups that we've seen on Reddit, on YouTube, and across the internet. These hype groups, they promote certain stocks, generally high growth risky ones, and a bunch of short-term money gets plowed into them. For example, the recent saga that we've seen on Wall Street Bets, with GameStop, with AMC, and all of the other ones. We saw these stocks get out of control in terms of price, and people weren't afraid to throw their stimulus checks into them. Were they researching the fundamentals of these stocks? Most, of course, no. Did they understand the risks with these stocks? Most, of course, didn't. They were just trying to make short-term quick money. Michael Burry, who actually invested in GameStop when it was cheap, was not happy with all of this so-called uneducated money going into GameStop. He said, "If I put GME on your radar and you did well, I'm genuinely happy for you. However, what is going on now, there should be legal and regulatory repercussions. This is unnatural, insane, and dangerous." And one of the reasons for this is just because there's so much free money floating around. We've seen the new $1.9 billion in stimulus checks come through. We've seen the Fed keeping interest rates to pretty much all-time lows. This free money, a lot of it is entering the stock market, and a lot of it is entering these so-called meme stocks. Michael Burry clearly doesn't think this is natural or sustainable, and I tend to agree with him on this point. The next thing that Burry talks about that is inflating stock prices is all of this passive investing. He said, passive investing's IQ drain and stonks hype groups add to the danger. He said a while ago that index fund inflows are now distorting prices for stocks and bonds in much the same way that CDO purchases did for subprime mortgages more than a decade ago. The flows will reverse at some point, and it will be ugly when they do. Burry mentioned that central banks and Basel III have more or less removed price discovery from credit markets, meaning risk does not have an accurate pricing mechanism in interest rates anymore, and now passive investing has removed price discovery from the equity markets. The simple theses and the models that get people into sectors, factors, indices, or ETFs and mutual funds mimicking those strategies, these do not require the security level analysis that is required for true price discovery of stocks. This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis, in that price setting in that market was not done by fundamental security level analysis, but done by massive capital flows based on Nobel approved models of risk that proved to be untrue. He said, the dirty secret of passive index funds, whether open-end, closed-end, or ETF, is the distribution of daily dollar value traded among the securities within the indices that they mimic. In the Russell 2000 index, for instance, the vast majority of stocks are lower volume, lower value traded stocks. He said, "Today I counted 1,049 stocks that traded less than 5 million in value during the day. That is over half, and almost half of those 456 stocks traded less than 1 million during the day. Yet, through indexation and passive investing, hundreds of billions are linked to stocks like these. The S&P 500 is also no different. The index contains the world's largest stocks, but still, 266 stocks, over half, traded under $150 million today. That sounds like a lot, but trillions of dollars in assets globally are indexed to these stocks. The theater keeps getting more crowded, but the exit door is the same as it always was. All of this gets worse as you get into even less liquid equity and bond markets globally. Potentially making it worse will be the impossibility of unwinding the derivatives and naked buy/sell strategies used to help so many of these funds pseudo-match flows and prices each and every day. This fundamental concept is the same one that resulted in the market meltdowns in 2008. However, I just don't know what the timeline will be. Like most bubbles, the longer it goes on, the worse the crash will be." End quote. Because the thing about today's market is, let's be honest, most investors, they can't determine the intrinsic value of a stock. You ask them and they wouldn't even know where to start. But they do know how to put money in an index fund. They know how to follow the crowd. But how many people actually do the intrinsic value analysis of each stock? Not that many, and this adds to the danger of the market. I personally, Cooper, I don't mind index fund investing. What I do mind is index fund investing by those who have no idea what they're actually investing in. This is a recipe for disaster, and if things start to go down, most of these investors will just panic and sell. So I'm gonna ask you, the viewer, do you know how to determine the intrinsic value of a stock? Do you have a strategy for what you'll do if the market crashes? People who can answer these questions will be the ones that do well over the long term. And Michael Burry, he's been saying that the market is too high for a while now. He's been saying these things since 2019 and potentially even earlier than that. And you've got a whole bunch of people out there who think Burry has lost his touch. But we must remember that he's never predicted the timing of this crash. He's just warning that things are getting dangerous. As he says, the market's dancing on a knife's edge. He mentioned in a tweet, "Those saying me and Munga and Singer are so out of touch are not considering that we have seen this all before, and not just once." They've been around the game for quite some time. They've seen and studied the market crashes of the past. So perhaps these are people we may want to listen to. The other thing that Burry's warning strongly of is inflation. Inflation, of course, is just the increase in the price of everything, devaluing what your dollar can buy. Burry said the US government is inviting inflation with its MMT-tinged policies. Brisk debt to GDP, M2 increases, while retail sales, PMI stage V recovery. Trillions more stimulus and reopening to boost demand as employee and supply chain costs skyrocket. He said to read the book The Dying of Money, Lessons of the Great German and American Inflations. In this tweet, he compared the hyperinflation in Germany in the 1920s to what's going on in the US today. He tweeted, "Germany, in brackets the US, started by not paying adequately for its war, in brackets for the US on COVID and the GFC fallout, out of the sacrifices of its people, taxes, but covered its deficits with war loans, treasuries in brackets, and issues of new paper, Reichsmarks, and in the case of the US today, dollars. Hashtag doomed to repeat." History is not useless, he said in another tweet. This text explores the 1970s American inflation, which is more relevant today than one might think. So Burry seems to be massively against these new economic theories that the government has come up with to manipulate the economy. One of those is MMT, where it's argued that the government can spend as much as they want because they can issue their own currency and pay it all back that way. As we all know, our parents were wrong. Money does grow on trees now, and it's been handed out freely by the governments. But problems occur when you think you can give away endless amounts of money. Problems like inflation, where your dollar becomes massively devalued. One thing that we don't want to end up like is Germany in the 1920s, where inflation crept up on them from behind without any warning. Burry sent out his warnings on inflation, on passive investing, on high debt levels, on hype investing. Is he right to be concerned about these things, or is he just an old grudge who's lost his touch? Funnily enough, I think we should be paying attention.